independent emerging markets commentator Geoffrey Dennis, who joins us on the phone line from California. Jeff, as always, thanks for staying up for us, and good evening to you. How bad do you think the situation is from a market's perspective?
I think a lot of bad news is getting itself priced in now. Obviously, the immediate outlook is not good because you've got a Fed that's moving relatively slowly, as I suspect they probably should, because I think the real signs here of recession are still limited. And yet at the same time, you've got the risk out there of the escalating trade war, which is really what's been the main driver of the markets going down. And of course, if the trade war goes further and leads to more slowdown in China, more slowdown in the US, then you could end up with a global recession. But markets have got quite a bit cheaper. But clearly, you need some better economic data, or you need some agreement on the trade war, and the latter seems very unlikely, I think, to stabilize things, at least in the short term, because, of course, sentiment has deteriorated so badly.
Jeff, the other angle, obviously, and what came out from the Jackson Hole Symposium was that, it was a sense that it is a regime shift in the economic conditions. Interest rates are not going up anytime soon. The role of the dollar is under scrutiny as a safer haven investment. I mean, what's happening now, even with central bankers suggesting that, you may not actually see next year being any different?
No, I think that's right. I mean, I think what's happening is the markets, and indeed everybody who commentates on the markets, including me, including you, and very likely the Federal Reserve as well, and probably President Trump, is aware of what the yield curve is telling us, and what the role typically is of the yield curve in, if not forecasting recessions, but often being consistent with the development of a recession. So I think while long-term bond yields remain as low as they are in the U.S. and possibly, who knows, go even lower, I think that's going to mean this debate on the economy is going to continue, short, of course, of there being a spurt in the economic numbers, which frankly doesn't seem very likely. So I think this is going to take some time to play out, and I think it will play out into 2020. My own view is that there's a very good chance, probably more than 50-50, that sometime between now and the November 2020 U.S. election, there will be the beginning of a downturn in the economy, i.e. 2 quarters of negative growth. The signals are all pointing in that direction, but the Fed has to really, it's hard for them to anticipate this because the real economic data are still, they're not great, but they're not bad. And the Fed, of course, wants to keep some firepower in reserve should there actually be a recession. So, yeah, I think you're dead right. This is going to carry on for a while. And meanwhile, of course, the dollar does stay strong because you can make a case that a lot of the other economies around the world are even weaker than the U.S. is.
The other the aspect being is, some comments suggesting that central bankers are actually dealing with the problem that the monetary policy did not cause and it cannot fix. I mean, the direction is purely on the back of what's been happening with regards to the trade sentiment. And how that changes is something central bankers need to closely watch, and it's not in their control.
Correct. It's not in their control, but I think this point's being a little bit overplayed because while the Federal Reserve and central banks generally cannot react, if you like, to the twists and turns of this extraordinary trade war that we're in now between the U.S. and China, what the Federal Reserve can do is react to any economic damage or indeed any inflationary pressure in the other direction that could arise from the trade war. So they don't have the tools to respond to the trade war per se, but were there to be an economy in the U.S. and globally pushing towards a recessionary environment, partly presumably because of the trade war, which is, of course, hitting the net export side very, very severely, well, then they do have the tools to deal with that. So I think it's a little disingenuous to say they don't have the tools to deal with the trade war. They do have the tools to try to lean in to a softer economy, which is undoubtedly softening partly because of the trade war, not only because of its impact on net exports, not only because of its impact on investment, of course. Companies are very nervous to put new investment in place given the trade war, but also they can lean in with lower interest rates to help boost expectations of all agents in the economy, which will be damaged by the trade war. So, there are things the Federal Reserve can do.
Well, let's wait and watch if some of the things are done or no. But right now, the trade war occupies center stage. Geoff Dennis, thanks so much for staying up for us and talking to us today on Bloomberg Quint.